Welcome back to another digital lecture series of financial market and instrument. We are discussing the financial market and instrument, and in that we had already discussed about the development banks. In today's class, we are going to know that what the DFIs or the development financial institutions is. So without delay, let's start our class of today, that is development financial institutions. So the development financial institutions are specialized institutions set up primarily to provide development or project finance, especially in developing countries. And after independence, as the role of commercial banks were limited to providing working capital financing for short periods, the DFIs or the development financial institutions were set up to finance the development on long-term basis for the significant sectors of the economy like infrastructure sector. And DFIs differs itself from commercial banks as it strikes a balance between commercial operational norms as followed by commercial banks on one hand and developmental responsibility on the other hand. And DFIs are not just plain lenders like commercial banks, but they act as companions in the development of significant sectors of the economy. So as we have already discussed that what these development banks are, so this is what are the development financial institutions are. The development financial institutions are the specialized institutions or organizations, those who are conceptualized or those who are developed for the development of the important components or important sectors of the economy, those who are going to make the economy vibrant or going to boost the economy. So as we can consider in the case of India after independence, as we know that there are commercial banks, or we can say that there are prime financial institutions, those has been established and taking care of the economy or taking care of the financial system. But still the generation of capital or boosting the capital or formation of capital is not that much taken care by the commercial banks. So the commercial banks are not able to cater the need of the development, or we can say that they are not going to justify or they cannot justify the development of the economy. So to take care of the development of the economy or to have a balanced growth of the economy, these development banks or these development financial institutions have been conceptualized. As we have already said that these development financial institutions are formed according to a special act. So a special provision or special act has been forwarded, and these development financial institutions are conceptualized, those who are going to focus on the development of some specific sectors like for say infrastructure. A DFI is defined as an institution promoted or assisted by government mainly to provide development finance to one or more sectors or subsectors of the economy. And the institution distinguishes itself by a judicious balance as between commercial norms of operation as adopted by any private financial institutions and development obligations. And it emphasizes the project approach, meaning the viability of the project to be financed against the collateral approach. So these development financial institutions are the specialized institutions, as we have said, and the approach of these DFIs or these institutions are more project oriented, or the approach is on the specific projects rather than the collateral approaches, what we are saying. Apart from provision of long term loans, equity capital, guarantees under underwriting functions are also undertaken. And a development bank normally is also expected to upgrade the managerial and the other operational prerequisites of the assisted projects. Now we will understand that what is the role of this development finance. By now we have already understood that these development financial institutions, or that these DFIs are specially designed organizations or institutions. What we are saying, they are being conceptualized for the development of the economy or for the upliftment of the important sectors of the country, those who are going to cater or to boost the economy of the country. Now, what is this development finance and what is the role of this development finance? Let us understand. So, it is supposed to identify the gaps in efficacy of institutions and markets and act as a gap filler. And it makes up for the failure of financial markets and institutions to provide certain kinds of finance to economic agents who are really interested to improve the working of economy. And it targets to economic activities or agents which are rationed out of the market, and it motivates the agent to take risky businesses with venture finance, and it helps the funds seekers by providing consensual funds at lower rate of interest. And social return of DFIs is quite high, and keeping these facts in mind, central banking system also supports development financial institutions. And it is specialized in nature and involved long term finance, and it is exclusively meant for infrastructure and industry, finance for agriculture and small and medium enterprises development, and financial products for certain sections of the people who needs funds for development perspectives. So, we can say that this development finance is a gap filler. So, these are the one who are going to bridge the gap, or we can say that these are the bridge finance, those who are going to bridge the pits of the development, or we can say that it is going to promote those sections or those sectors, those businesses or those entrepreneurs, those who are seeking fund for the developmental works. And obviously, as we have already said, that these developmental works need the finance for long term, and definitely they need the finance at a low rate of interest, and this is what is the focus of this development finance. And as it is moreover a social beneficiary activity, or lot of benefit is catered or rendered to the society by these activities or by this finance, the central banking system is also supporting this development finance. Now, we will understand that have a look on the history of this financial institution, or we can say the emergence of these financial institutions. So, these DFIs are created in developing countries to resolve market failures, especially in regard to financing of long term investments. The DFIs played a very significant role in rapid industrialization of the continental Europe. And many of the DFIs were sponsored by national governments and international agencies, and the first government sponsored DFI was created in Netherlands in the year 1822. So, these DFIs or these financial institutions are being considered very significant, and these are supposed to boost or to rapid up the industrialization of the continental Europe. And the first government sponsored DFI, we can say, was established in the year 1822 in Netherlands. And in France, significant development in long term financing took place after establishment of DFIs, such as credit mobilizers over the period of 1848 to 1852. And in Asia, establishment of Japan Development Bank and other term lending institution foster rapid industrialization of Japan. So, if we will see that this is what emerging trend of the development institutions or development financial institutions in Asia is, and the success of these institutions provided strong imputes for creation of DFIs in India after the independence and in the context of the felt need for raising the investment rate. So, RBI was entrusted with the task of developing an appropriate financial architecture through institution building so as to mobilize the direct resources to preferred sectors as per the planned priorities. And the DFIs were established mainly to cater to the demand for long-term finance by the industrial sectors, and the first DFI established in India in 1948 was Industrial Finance Corporation of India IFCI, followed by setting up of state financial corporations, that are the SFCs, what we are saying, at the state level after passing of the SFCs Act 1951. So, the need is very much considered in late 18th century in the European country, and the Netherlands is the one who come up for the first time establishing a development financial institutions, and like that various countries come up with the financial development financial institutions. And in Asia, if we will say that Japan is the one who first take its steps for the establishment of Japan Development Bank. And then India, after the independence, for catering the development sectors, the Reserve Bank of India has conceptualized for the formation of the development financial institutions, and IFCI is the first development financial institutions, as we have already said, is of India. And after that, the state financial institutions are also set up according to the SFCs Act 1951. Now, let us have a look on the financial institutions set up between 1948 and 1974. So, beside IFCI and SFCs, in the early phase of planned economic development in India, a number of other financial institutions were set up, which include the following, like the ICICI Limited, which was set up in 1955, LIC in 1956, Refinance Corporation for Industries Limited in 1958, which is later taken over by the Industrial Development Bank of India, and Agricultural Refinance Corporation in 1963, UTI and IDBI in 1964, Rural Electrification Corporation Limited and HUDCO Limited in 1969-70. So, Industrial Reconstruction Corporation of India Limited is also there in 1971 and GIC 1972. So, these are the DFIs which were set up between 1948 and 1974. Let us see the DFI setup after 1974 and the notification of certain institutions as public financial institutions. So, an important change that took place in 1974 was the insertion of Section 4A to the Companies Act 1956, where under certain existing institutions were categorized as public financial institutions or PFI, and the power of central government to notify any other institution as PFI were laid down in that particular section of the Act. And in exercise of these powers, the Government of India has been notifying from time to time certain institutions as the public financial institutions, and as on date under the Section 4A, 6 specified institutions are regarded as PFI, and it has been provided that the securitization company or a reconstruction company which has obtained a certificate of registration under subsection 4 of section 3, the securitization and reconstruction of financial assets and enforcement of Security Act 2002 shall also be regarded as the PFI, or we can say that the public financial institutions. So, besides these institutions, Government of India has been notifying from time to time certain other financial institutions as public finance institutions, and as on date additional 46 institutions have been so notified. Thus, in all 52 institutions have been categorized as PFI. So, there are 52 institutions which are categorized under the public finance institutions. So, this is what the scenario after the 1974. There is certain changes in the law or Companies Act we are saying, and with the addition of the section 4 of the Companies Act, there are various institutions where time to time taken up as the PFI or public finance institutions by Government of India. So, this is how is the scenario of this DFIs after 1974. And the financial institution set up after 1974 have been as follows. There are certain institutions, we will say that NABARD was set up in 1981. Exim Bank functions carved out of IDBI is there in 1982. SCI Limited in 1986. PFC Limited, IRFC Limited in 1986. IRDA Limited in 1987, IRCTC Limited and TDICI Limited. So, like this, these NHB in 1988, TIFC Limited in 1989, SIDB in 1989, DFI Limited in 1995 and IDFC Limited in 1997. These are the institutions, or these are the PFIs or financial institutions which are set up or come up after 1974. And apart from the fact that they cater to the financial needs of different sectors, there are some significant differences among them. So, while most of them extend direct finance, some extend indirect finance and are mainly refinancing institutions that are like SIDB, NABARD, NHB, which also have a regulatory or supervisory role. So, apart from extending the direct finance, also they are catering some other functions like supervisory or regulatory role or regulatory functions, as we have said. So, next we will see that how these development financial institutions are classified. So, DFIs can be broadly categorized as all India or state or regional level institutions depending on their geographical coverage of operation, and state or regional level institutions are a distinct group and comprise various state financial corporations, SIDCs and NEDFIs limiteds like that. And functionally, if we will see, all India institutions can be classified as term lending institutions, and in which we include IFCI, IDBI, etc. And these are extending long-term finance to different industrial sectors. And we have the second category in all India institutions. We have refinancing institutions like NABARD and NHB, which are extending refinance to financing as well as non-banking intermediaries for finance to agriculture, small scale industries and housing sectors like that. And in third category, we have sector specific or specialized institutions like Exim Bank, like HUDCO, etc. And the fourth one, we have investment institutions like an LIC, UTI, GIC and other venture capital funds limited. So, this is how we are classifying the development financial institutions. Now, we will see what is the operating environment of this DFIs. So, historically, low cost funds were made available to DFIs to ensure that the spread on their lending operations did not come under pressure. And DFIs had access to soft window of long term operations funds from RBI at concessional rates, and they also had access to cheap funds from multilateral and bilateral agencies duly guaranteed by the government, and they were also allowed to issue bonds which qualified for SLR investment by banks. And for development of funds, they faced little competition as the banking system mainly concentrated on working capital finance. With initiation of financial sector reforms, the operating environment for DFIs changed substantially, and the supply of low-cost funds was withdrawn, forcing DFIs to raise resources at market-related rates. And on the other hand, they had to face competition in the areas of term finance from banks offering lower rates. So this is what the operating environment of DFI is. Now we will see that there is a transformation of DFIs into banks. So what is the scenario of transformation of DFIs into bank? Let's have a look. That the operational guidelines for enabling a DFI to convert to universal bank were issued in 2001 following the policy pronouncement by Reserve Bank of India on approach to universal banking. And the DFIs were advised that those who choose to convert into bank may formulate a roadmap for the transition path and strategy for smooth conversion over a specified time frame. And it was also advised that the plan should specifically provide for a full compliance with prudential norms as applicable to banks over the proposed period, and should be submitted to RBI for consideration and further discussion if necessary. And out of the 10 DFIs then being regulated and supervised by Reserve Bank of India, only 2 DFIs, that are ICICI Limited and IDBI, submitted the transaction path to Reserve Bank of India and government respectively for consideration, and 2 DFIs expressed their intention to submit the roadmap, but sought more time to convertize their plan by appointment of consultations, etc. So one DFI forwarded a broad roadmap for conversion to a restructured NBFC by 2005, also seeking support from the government, which was considered crucial for the success of the envisaged conversion, and the proposal was forwarded by Reserve Bank of India to the government for their consideration. The remaining 5 DFIs did not show any inclination to consider the option, as no proposal was received from them. So the transaction plan of IDBI, which involved long widened legislative process and is finally at the stage of fructifying now, is discussed subsequently. So the transaction plan of IDBI, which involved long winded legislative process and is finally at the stage of fructifying now, and the roadmap submitted by ICICI Limited was successfully implemented, and conversion to the bank was achieved in 2002. So the development financial institutions, if we will just look into that, although they have a very long history or they emerged long back, and if we will consider of our country, it was emerged long back in 1948, just after a couple of years of independence, but they didn't flourish that much, or we can say that their functioning is limited because of the closed economic system. So after the financial crisis of 1980s and 1990s, so after this financial crisis that happened mostly with Mexico, Argentina, Poland, and even to India. So after this financial crisis, these countries open up their market or make the economy free, and with the opening of the market or economy to the foreign countries, or by giving the economy a wider exposure, the role of DFIs was more into place, or we can say that more DFIs come to work more widely and vibrantly. And these DFIs are not confined to only developmental sectors or developmental programs. There are also provision of transformation of these DFIs, these development financial institutions into bank. And in 2002, the ICICI was set up or transformed into a full-fledged bank with all the roadmap provisions and all the criteria that are been given by the Reserve Bank of India for the transformation, and IDBI is in the transit or in the process of being transformed into the bank. So, this is what the development financial institutions are. So, this is what the development financial institutions are, and we know about the emergence and history of the development financial of the world economy and also India. We know how they are working and what are the phases of the development financial institutions and what are the time to time changes and challenges that are faced by the development financial institutions. So, this is all for today's class. In forthcoming classes, we will be discussing some more interesting topic on the financial market and instruments. For today, this is all. Thank you.